Welcome to the Deep Dive. Today our mission, well, it's pretty focused. We're looking hard at the Kraft Heinz Company.
That's right. Big name in food globally.
And we're not just glancing at the Q3 2025 earnings. No. We're really digging into the data, trying to understand this huge strategic update they announced.
Yeah, the plan to split the whole company in two, that's massive.
It really is. So our sources, they show the key financial numbers, sure, but also specific product investments, and like you said, this plan to create two separate companies.
And it's happening at a really interesting time. You can almost feel the tension in the reports. Management's dealing with some serious economic stuff, inflation, volume struggles.
While also planning this incredibly complex corporate separation. It's like trying to juggle while riding a unicycle.
Exactly. It feels like, a mix of playing defense, trying to be agile, but also making this aggressive long-term restructuring move.
Okay, so let's ground ourselves. The numbers first. Q3 2025. Looked a bit tough at the top line.
Yeah, overall net sales were down 2.3% compared to last year.
And organic net sales, which strips out some things like currency effects, that was down 2.5%.
On the face of it, yeah, not exactly shouting healthy quarter.
But management was quick to add some important context, weren't they?
They were.
Yeah.
They pointed out that this Q3 performance, even though it's a decline year over year, it was actually a modest improvement compared to how things looked in the first half of the year.
Okay. So it's like the bleeding slowed down a bit.
Kind of. It suggests maybe their operational tweaks are starting to help stabilize things, even if they haven't hit growth yet. More stabilization than acceleration, you could say.
Right. And looking closer at that net sales number, you see that classic push and pull we see everywhere these days.
Is inflation game at the checkout? Yeah.
Their pricing, it went up 1.0 percentage point year over year. They said it was pretty strategic, focused on things like coffee, where input costs just shot up.
That's the standard playbook in consumer goods, right? Pass on costs where you think you can.
But the other side of that coin
Was the consumer reaction. Pretty strong. That 1-point price increase, it got completely swamped by a volume mix decline of 3.5 percentage points.
Wow, 3.5 points. So people really bought less or maybe traded down.
Looks like it. Significantly less volume or perhaps shifts to cheaper store brands. That kind of resistance, it hits the bottom line fast.
And you definitely see that in the margins. Adjusted gross profit margin had tightened up by 200 basis points, a full 2%.
Yeah.
Landed at 32.3%.
Yeah, that's a noticeable squeeze.
And even more stark, adjusted operating income dropped, nearly 17%?
Down
to $1.1 billion. That's a big drop. What drove that?
It was sort of a perfect storm. You had commodity and manufacturing inflation. The cost just kept rising faster than they could find efficiencies.
Okay, makes sense.
Then you layer on that unfavorable volume mix we just talked about, people buying less profitable stuff, or just less overall.
Right.
But here's where it gets interesting. They also made a choice. They increased their selling, general, and admin expenses. SG&A went up, and that was mainly driven by advertising spend.
Wait a second. If your gross margin is shrinking because costs are up and people are buying less, why ramp up advertising? Doesn't that just, hammer the P&L even harder in the short term?
It seems counterintuitive, doesn't it?
Yeah.
But it highlights that tension we mentioned. Management seems to view it as a necessary investment for the future.
An investment? How so?
They're spending more now to try and boost brand relevance, stop that volume decline over the longer term. They're basically accepting a hit to operating income today.
Higher ad spend.
To try and fix the root cause, that volume mix problem, which is what's really been hurting them long term. It's a trade-off. Today's profit versus tomorrow's market share.
Okay. That's a gamble. So the P&L, it looks challenged, but then you flip to the cash flow statement.
And it's a whole different picture, much healthier. This is kind of the counter narrative that's keeping things stable.
The bright spot, you said.
Absolutely. Year-to-date, cash performance is really quite strong. Free cash flow is up 23.3%. That's $2.5 billion.
That's solid. And the conversion rate?
That's the one analysts really watch. Free cash flow conversion hit 109%. That's up a massive 34 percentage points from the year before.
109%. So they're generating more cash than they're reporting in net income. How they pull that off while operating income was under so much pressure?
It really shows some serious discipline on the balance sheet side of the house.
Okay.
That improvement came mainly from managing working capital better. Things like keeping inventory levels tight, managing accounts payable smartly.
Getting cash in faster, paying bills maybe a bit slower where possible.
Oh, exactly. And they also spent less on capital expenditures, lower CapEx. So basically, while sales are getting hit by the economy, their finance folks are doing a great job managing the balance sheet to build up a defensive cash position. Classic move in turbulent times. Ensures liquidity, stability.
Got it. And that stability, it relies on executing well internally. Which brings us back to where those ad dollars are going. You mentioned a slight operational improvement compared to the first half.
Yeah, about 100 basis points improvement. And management was clear it wasn't across the board. It was driven by specific brands.
Which ones were the stars?
The sources called out three main drivers. Lunchables, cream cheese, that's Philadelphia, and Primal Kitchen.
Interesting. In a portfolio that huge, just a few brands are really pulling the weight for that improvement. Suggests they're being very targeted with resources.
Very focused, yeah.
So let's look at that focus, particularly in North America. Lunchables, clearly a priority, still growing. They launched new stuff like a no-thaw PB&J. That sounds like a parent's dream.
Right. Fixes a real headache. And they mentioned new crackers, cookies. Plus, their whole back-to-school push apparently scored an 85% execution rating. They seem to be nailing that category.
Okay, Lunchables is humming. But then Kraft mac and cheese. That's like sacred ground. What are they doing there?
They announced a big renovation, a new product, 50% bigger size, but the headline was cleaning up the ingredients.
How so?
The big promise. No artificial flavors, no artificial preservatives, and no artificial dyes.
Wow. You don't mess with an icon like mac and cheese lightly. Is that about appealing to younger, health-conscious parents? Or maybe fending off those clean label competitors?
I suspect it's probably a bit of both. Changing a core product like that is risky, definitely. But the reports suggest it's needed to stay relevant. Using innovation, to bridge that gap between their classic status and what today's consumers want.
Makes sense. Any other examples?
Yeah, Capri Sun also saw some action. Moving beyond just the pouch, they launched single-serve bottles.
Oh, interesting. For different occasions.
Exactly. They think it'll be incremental business capturing, like convenience store sales, vending machines, places. The pouch doesn't always work.
Okay. So targeted innovation in North America.
Duh.
Now, switching globally, the Heinz brand itself seems to be leading this taste elevation strategy.
That seems to be the banner, yeah. And internationally, it looks like it's working.
How so?
Well, they launched a new global ad campaign called Look Familiar,
Yeah.
and you see some concrete results, like they introduced Heinz-flavored mayos in Canada, and boom, Q3 dollar share jumped 2.8 percentage points compared to last year. That's taking share from competitors.
Nice. And elsewhere?
In the international developed markets, they renovated something called TK0 in Europe, apparently successfully, and total Heinz ketchup dollar share went up 1.1 points in those developed markets.
So success in sauces and condiments seems pretty key.
Yeah.
Which kind of leads us nicely into the geographical performance, because it sounds like two totally different stories depending on where you look.
That's a perfect way to put it. You've got the emerging markets, which they clearly see as the growth engine.
How did they do?
Organic net sales were up a healthy 4.7% in Q3. That was driven by continued double-digit growth in places like Latin America and the Middle East Africa region.
Double digit. Okay, that's strong.
Yeah, and they even saw Brazil recover, which helped the mix, partly thanks to that Heinz push we talked about.
And they're building infrastructure there too, right? Expanding distribution.
Massively.
Yeah.
They noted adding over 60,000 total distribution points in emerging markets. That's serious scaling.
But it wasn't all smooth sailing even there.
No, even the growth engine had a bit of a sputter. That strong performance was partly dragged down by some challenges they mentioned in Indonesia. It's why the overall outlook maybe isn't quite as high as that 4.7% might suggest.
Okay, so emerging markets, strong, but with caveats. Now, contrast that with the developed markets. North America, international developed.
Yeah, the headwinds feel pretty constant there. In North America, that volume mix decline was rough, down 4.2 percentage points.
Ouch. Any reason given?
The source material pointed to ongoing softness in food service. Restaurants and cafeterias. U.S. away-from-home traffic is still apparently suppressed. People still cooking at home more, maybe?
Seems plausible. And international developed.
Organic net sales there declined 1.4%. The main culprit mentioned was weakness across the whole UK industry in the meals category.
So the category itself is struggling.
Yeah. Management said they're holding their share within that weak category, but, holding share of a shrinking pie isn't exactly a growth strategy. It really highlights why they need that constant targeted innovation we talked about earlier in these mature markets.
Right. So this split, you see strong growth potential globally in some areas versus mature, struggling staples, particularly in North America. it kind of sets the stage perfectly for the really big news.
The decision to split the company.
Exactly. Splitting the entire Kraft Heinz Company into two separate, independent, publicly traded companies.
It's a huge move. Approved by the board, they're planning a tax-free spin-off aiming to close it in the second half of 2026. They're essentially reshaping the whole organization to match those two different realities we just outlined.
And they've already sort of sketched out the identities. Company A is going to be the Global Taste Elevation Co.
Right. Focused on global sauces, shelf-stable meals. Its big billion-dollar brands are Heinz, naturally, but also Philadelphia cream cheese and Kraft mac and cheese.
Okay, hold on. That's Company A. Company B is the North American Grocery Co.
Yep. A scaled portfolio focused squarely on North American staples. Its billion-dollar babies are Oscar Mayer, Kraft Singles, and Lunchables.
All right, so here's the question that jumps out at me. The rationale they gave is, reduce complexity, let each company focus its resources better. Makes sense.
Standard spin-off logic.
But looking at those brand groupings,
Yeah.
why put Kraft Mac and Cheese and Philadelphia, two brands that feel like quintessential North American staples, into the Global Taste Elevation Company alongside the powerhouse Heinz brand? Wouldn't they fit better in the North American Grocery Co.?
That is the absolute crux of the strategic thinking here, I think. It seems less about where the brands are today and more about where they want them to go. Meaning the current structure probably creates internal friction. R&D, supply chains, marketing budgets, they're likely pulled in two directions. Trying to manage the needs of a fast-growing, globally scalable platform like Heinz and the very different regionally focused needs of North American staples like Oscar Mayer.
So splitting lets them specialize.
Precisely. They can completely separate the R&D focus, the manufacturing footprint, the marketing strategies. The bet for the Global Taste Elevation Co. is that they can take Philly and KMC, these incredibly strong North American brands, and apply the Heinz playbook to them, aggressively expand them internationally, leveraging the existing Heinz global infrastructure.
I see. So Company A gets the global growth mandate for all its brands, while Company B can just focus intensely on winning in the North American grocery aisles with its specific portfolio.
That seems to be the plan. And they were careful to mention financials around this split. They committed to keeping the net leverage that's debt relative to earnings near 3.0x for both entities.
Which is seen as pretty reasonable.
Yeah, and they plan to actively use any excess cash they generate between now and the split to pay down debt. They want both new companies to launch from a position of financial strength and stability, no overburdened balance sheets from day one.
Okay, makes sense. So finally, let's wrap with the updated outlook for 2025. Q3's performance meant they had to tweak the full-year guidance.
They did. They lowered the expectation for organic net sales for the full year, now expecting it to be down 3.0% to 3.5%.
And the reasoning?
Basically reflects that ongoing pressure in U.S. retail we discussed, plus maybe slightly slower growth coming out of emerging markets than hoped, mostly because of that drag from Indonesia.
Got it. And earnings per share. Adjusted EPS.
That range was also tightened and slightly lowered, now expected between $2.50 and $2.57 per share. But there is a big non-operational factor hitting that number.
Oh, what's that?
Taxes. They flagged a pretty significant headwind, about 23 cents per share compared to last year, just from tax changes.
23 cents? From taxes alone, why?
It's due to various countries putting in place those global minimum tax rules, plus some changes to their own corporate structure impacting taxes. Essentially, as a big multinational, they can't use low-tax jurisdictions quite as effectively as they used to.
So their overall corporate tax rate is just going up.
That's the gist of it. Hits the bottom line directly.
But sticking with the theme, the cash flow story, still positive.
Still the bright spot. They actually improved their outlook for free cash flow conversion. They raised the guidance. Before it was at least 95%. Now it's at least 100%.
Wow. So they expect those working capital efficiencies to continue strongly through year-end.
Seems so. Financial discipline remains a key strength.
Okay, so summing up this deep dive, we learned operational stability seems to be returning, maybe slowly, driven by really focused investment in key brands like Lunchables.
Right, and we saw that stark contrast, the essential growth coming from emerging markets running hard, even with some bumps.
Set against that real consumer resistance and pressure in the big developed markets like North America and the UK.
And tying it all together is this massive strategic pivot, the decision to split the portfolio, to create two distinct companies.
Yeah, it's the highest stakes move they're making. Which leads to maybe the final thought for you, our listener, to chew on.
It's that tension embedded right in the split itself. The Global Taste Elevation Co. gets Heinz, which is already a global giant, giving it instant scale and reach.
Sure.
But the big question is, can this new entity really, truly transform the growth path for Kraft Mac and Cheese and Philadelphia? These are historically North American icons, deeply saturated in that market. Can they successfully make them into genuine global growth engines, applying that Heinz model before the split actually happens in 2026?
Or will they remain primarily North American giants housed within a global company structure?
Exactly. It suggests the real heavy lifting of defining the future global identity and strategy for those specific brands. Well, it's probably just getting started.
Definitely a lot to watch there. A fascinating look at a company in major transition. We'll see you next time for the next deep dive.